markets run in cycles, and you got to think of the ups and the downs. You got to protect yourself, especially if you're doing, mortgages.
Yeah.
And we know a few partners in that market, or a few people that were doing deals that they've lost everything. They were a little too risky, a little too aggressive. Sometimes dollar signs got in the way or their emotions got in the way because they were definitely going to make money.
Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock-solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey, welcome back to the Ironclad Underwriting Podcast. I got my good friend and business partner, Frank Patalano, here with me. In the last episode, we discussed one of my big red flags of trusting and not verifying. And so today we're going to discuss another one of my big red flags, and that is using temporary trends for the long game, or using something that's happening in like a micro market for like everything you're doing. And then that's no bueno. So welcome, Frank. How are you doing today?
Hey, not too bad. Wow, we could spend a lot of time on this, depending on where we want to go. We'll see how it plays out.
So I underwrite. I help people with their underwriting. I am an underwriting consultant, I guess you can say, with my second set of eyes business, as well as my coaching that I do. But I've had clients, more than one, come to me, and so this was back in 2021-ish. San Antonio was a booming market. That was like one of the fastest growing ones in the nation. They had like 30% rent growth for like a couple years. 30%, 30. And the client came to me and put that in his underwriting. It's like, hey, I'm going to underwrite for 30% because that's what we're getting. After 2022, 2023, interest rates started climbing. San Antonio's market like plummeted. They, in fact, had negative rent growth. People were leaving because it was so expensive. But this guy, if he, and I pointed it out to him and he went ahead with it anyway. He was going to use that 30% rent growth for his underwriting, so he make his offer with that.
Oops.
Yeah. And that might be one of the few that have been foreclosed on in the last few years if it was accepted. And so that is scary to me. And things, it's like you can't tell what's going to happen 3, 5, 10 years from now in your market. You buy a property and you pull out your crystal ball, and you buy a property, and everything's hunky dory, except there's no crystal ball, and so you have to use your best guess. So what do you have to say about that?
I mean, in stocks, they talk about the trend is your friend, but real estate is a slower play out of trends. And when the trend turns, it's very hard to fix what you've already assumed. So you focus a lot on Texas. I know the big thing. It's a similar situation in Phoenix. A few years ago was that Phoenix had 25% year over year rent growth for like 2 or 3 years in a row. And a lot of people were jumping into Phoenix, and I was passing on a lot of Phoenix deals, and people thought I was crazy. Now, don't get me wrong. Phoenix is a great market. I mean, would I love to own something in Phoenix? Yes. It still has a lot of long-term growth. People are moving there from California and elsewhere. But to underwrite at 25% year over year growth, at some point the music needs to stop. Markets run in cycles, and you got to think of the ups and the downs. You got to protect yourself, especially if you're doing, mortgages. If you're borrowing money with 3, 4, 5 year hold times, it's not like you're doing a 30-year long term. Just these numbers. So last year, or the year before, Phoenix turned, and they had, if not break even, if not rent declines.
Yeah.
And we know a few partners in that market or a few people that were doing deals that they've lost everything. They were a little too risky, a little too aggressive. Sometimes dollar signs got in the way or their emotions got in the way because they were definitely going to make money. I mean, we're all entrepreneurs. We're used to taking risks, but definitely a lot of risks in that.
Yeah. There have been quite a few markets that had a decline. Austin, DFW, not so much. But there are parts in DFW that had declined. Parts in Houston had declined. San Antonio, definitely Phoenix. And these are all the hot markets everybody wanted to be in. And that's scary. And another thing is with low interest rates, as low as we had back in 2021, what were they, like 2.5%? And people were putting in a refinance into their decision in 3 years, and they were going to refinance it at like 1.5, 2% again. Well, if you've been investing between 2001 and 2024, which is 3 years later, you know interest rates did not go down. In fact, 2.5, they went up to what, 8, 9, 10% sometimes. If you're getting agency debt, yeah, you might get a little bit lower, but you're doubling or tripling your interest rate. And so that's another thing is you can't use a temporary artificially low interest rate and assume it's going to be like that forever. So,
Yeah,
and,
I
and
mean, I'm thinking of temp I mean temporary trends. So we're not just talking multifamily, obviously, but the concept in oil and gas. I mean, when oil prices are high, a lot of people get excited about drilling new wells, and we all know how long that takes. Well, I'm not an expert on it, but I mean, you've done a little bit. You know how long it takes to drill a new well, the planning, the steps,
right.
everything else. But oil has fluctuated a lot. So right now, the price per barrel, there's a lot of places that are not profitable. But 4 years from now, who knows? If the price per barrel is the right number, you can definitely make money in those wells that are just more expensive to build and create.
Do you remember during COVID, the 2020 years, you know what the oil price did in that?
There was
The
one, I think there was
what?
one time in 2021, maybe it was 2020, where oil futures went negative.
Yep.
So if you put the money in, you had to find a place to store a whole ton of barrels, but it would have made you money.
Yeah. And I mean, oil has consistently, and the oil is propped up by the government and everything, and actually global governments. I think we're sitting at what, like $70 a barrel right now, which is pretty reasonable. But yeah, it's like everything has a temporary trend. Everything and with multifamily syndicators and entrepreneurs, they get the shiny object syndrome. So they go from apartments to oil to crypto to ATMs to something. So they always see this like spike and like a temporary trend, and so they jump into that thinking that's what they're going to get into, and it's never the case. And it's like what you've always said is real estate is a long game. Yeah, it's not a get rich quick. You get into this and you know you're creating generational wealth, but you're not creating short-term wealth. You might sometimes, but that's not typically what happens. So,
So I mean, back to the temporary trends. I mean, this has definitely affected everybody's underwriting. I mean, not just our underwriting, but like you were saying, the years of low interest rates, the years of high rent growth, the years of low insurance rates and low taxes. In the past 2 years, we've seen every single one of those blow up in
mhm,
most markets, which
yep.
has caused this massive disruption and caused some foreclosures for people that were definitely too risky.
Yeah, and it's also affecting, and it's prices are starting to come down. But I mean, when you're into a property that you overpaid for because interest rates were so low and rent growth were so high, you want to get out of it at least breaking even. You don't want to come out at net negative. And so they're like trying to sell a $10 million property for 15 because that's what they have to sell it for. Yeah, they might be being able to make their debt service and pay insurance and taxes and stuff just to keep it barely floating at what they're currently bought it at, but they can't sell it where they want. And that's why some of our properties, they keep coming up on the market and they not get sold. And then 9, 12 months later, they come back onto the market and not get sold. It's like those people are trying to not lose money, but they don't have a property that's worth what they are expecting it to. And so that we're in a kind of a weird limbo right there because it's hard to get new properties. But also back then, if you weren't aggressive, you wouldn't get any property. So I mean, it's like a double-edged sword. You want a property, you have to be super aggressive. If you're super aggressive, then there's a higher chance that you're going to lose everything. So I mean, and of course, the seller is going to sell to the most aggressive one who they think can close. So I mean, maybe that's why I just sat out and sitting on the sidelines trying to do my own thing and watching what's going to happen with those properties and maybe pick them up at auction or something. I don't know.
Yeah, I mean, in 2019, I literally thought we were on the edge of a recession. Um, Nobody could have predicted COVID, so I was selling off properties that I did put the money to work in other deals, but if I had not sold them, most of them are worth 2.5 times what I sold them for. At the same point, the American dollar has also gone down a lot in value.
Yeah.
So like I said, I did do well, and I did put them into other things. But sometimes hard to predict. I mean, we're always trying to predict the future. Some people, I'm not saying I always agree with this. Some people talk about the time in real estate is more important than timing real estate.
Mm-hmm.
Um, I'm not saying they're wrong, but there are people that have overpaid and they're in a lot of pain right now.
Yeah.
And like I said, not just in the multifamily, with Airbnbs, I've seen that a lot depending on the market. So back to Phoenix, I remember posting a few articles on Instagram maybe a year or two ago that there was so many people that were buying single family homes and trying to rent them at top dollar through Airbnb. The problem is that pre 2020, while Airbnb was a thing, the supply of homes in one market was pretty small, and the demand was a constant, even if it was growing, or maybe it was growing slowly. Well, then we have this big explosion where supply is 10 times what it was. Demand did not go up by 10 times. So the pricing that they're getting on a nightly rate in Phoenix greatly shifted. And I know some people that lost their single family homes that they were using for rentals because, they might have borrowed more money against that house. And I always try to get people to underwrite based on long-term rental numbers. But then we have midterm rentals and then we have short-term rentals, and people were buying with a temporary trend. They were buying at the forefront of what is becoming a more mature Airbnb market now, you know?
So with Airbnbs and hospitalities, I mean, a lot of times your whole business plan is on a temporary trend. Because I mean, if say Metallica's playing in Phoenix and all the hotels are sold out or something, the Airbnbs can start charging out the wazoo for it. But that's like one weekend. You
Right.
can't do that like every week or every weekend. But some people think that. And so you have to consider the seasonality of things, especially with hospitality, RV parks. Even it's like people are going to be driving RV parks more in the spring, summer, and fall months than in the winter months, and so they're going to like destination places, and so you can charge more during certain months versus other months. But I mean, that's a whole other game there, trying to play everything
Yeah.
right.
So one of my favorite stories about that with temporary trends is when you and I underwrote that RV park near Talladega, the
Mm-hmm.
Speedway. And obviously we wanted to make it work, and we thought we could make money, this and that. But then when we really thought about it, we realized that the Talladega uh, motocross racing arena, they only have 2 major events a year.
Yeah.
So if you get rained out on one of those events, only two weeks a year are you making money. So that could greatly impact your entire year of profitability.
Yeah.
Obviously you try to pre-sell a lot of them, but just the whole concept, it's like, wow. And it's like, yeah, I'm not willing to risk that much money. I mean, we were trying to get it at a discount, but nothing like the risk I felt that it would be of 2 weekends a year for every 52 weeks.
Yeah. Well, one thing about that is those NASCAR fans, those are the true diehard ones that would actually rent an RV spot, couldn't care less if it was raining or not. But like you said, it's like 2 major events a year at the super speedway. And then you have like a few other events like happening throughout that are minor. Other than that, there's really nothing there other than the place to stop. So I mean, yeah, that one was questionable, but that one, I think at the price point we offered, it was reasonable, but that whole deal fell through because of whole other reasons. So
Yeah, it fell through other reasons, but just I was worried about the whole concept of if you're just underwriting to what I would consider a temporary trend.
yeah,
2 weeks a year is pretty temporary. You're basing your whole budget, your whole sales on 2 weekends. So as you know, I do a little bit of the boutique hotel space,
mhm,
and I'm thinking about temporary trends, especially when you buy. You have to become an expert in the market. I'll repeat again, because if you're buying and you're reviewing and underwriting based on high season, every market has its own little high season and low season. And what some people don't realize is that, like the Caribbean, or in many parts, I can't say every part, but in Dominican Republic, high season is actually December, January. The lowest season is basically June, July, and August. So when we underwrote, the guy gave us almost no numbers, and we were underwriting based on December and January, and maybe even February uh, returns. That's a rather temporary trend, especially if you don't know enough about your
yeah,
market. So when you're predicting $90 a night for rental, but then in the middle of July you're only getting $35 a night, and you're only 50% occupied, that just crushes any profitability on
yeah.
some of these deals.
And and whenever I've had students do RV parks with those kind of parks, I always try to get like the first previous 5 years of data. That way you can see the seasonal trends. You can see which months are most profitable. That way you're not going in thinking, all right, we're going to get $90 a night every night and we're going to be 75% occupied year round. And
Yeah, but that's a trust but verify thing as well. I mean,
yep,
you can definitely ask for tax returns,
yep,
but just the whole concept is it's pretty hard to prove some of that stuff. You can have
yeah,
people faking it,
yeah, that's true.
and especially in
But
foreign countries.
yeah, where they don't speak English as their first language.
I'm not just thinking of that, but let's just say the IRS in many countries is not as strong as the IRS here in the United States.
Yeah,
And if you're running a quasi cash business, the numbers can be faked a lot.
that's true. So overall, don't use temporary trends for your long business plan game. So anything else you want to add on that?
No, I mean, I think we hit some of the most of the major temporary trend issues we've seen in the past few years in multifamily, and I
Mhm.
also touched base on Airbnb and hotels and oil. So
Yeah, and this is what we have seen firsthand. If you have other ones, drop them in the comments or let us know, and we can discuss those in a future episode as well. So, well, if you don't have anything else, I don't have anything else. Thank y'all for listening to this episode. We'll catch you next time. This is the Ironclad Underwriting Podcast. Thanks. Bye.
thanks.
And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.